They told Africa to be patient. Ibrahim Traore refused, and his playbook is now reshaping whole economies. In early 2025, Ghana recorded a shock. Billions in gold export revenue flowed into the treasury in a matter of months, not years. The cause was not a new deposit or a technological miracle, but a governance decision to stop leakage, close smuggling routes, and insist that the value created on Ghanaian soil remain visible and taxable at home. What followed was fiscal space, new reserves, and a political moment that echoes Traore's doctrine: keep the wealth where it's made. And nations change overnight. For too long, Ghana's gold story was a tale of lost opportunity. Between 2019 and 2023, an independent analysis found a huge trade gap, minus 229 metric tons of gold unaccounted for, equivalent to roughly $11.4 billion that flowed off official records and reappeared in foreign markets, especially the United Arab Emirates. That leakage came from pervasive smuggling routes, informal buyers operating with impunity, and a weak chain of custody that allowed bars to leave as hand luggage or via neighboring countries. The result was predictable. Miners, many working artisanal pits, earned pennies while the bulk of value left the country. Then enforcement and institutions intervened, drawing lessons from West African experiments in resource control. Accra created a legally empowered national body to centralize purchasing, grading, and exports. The Ghana Gold Board, GoldBo, was given exclusive authority to weigh, assay, and export gold, and the state moved to buy into arrangements with major and small-scale producers alike. At the same time, a national task force was launched to tackle smuggling using surveillance, technology, and a tougher criminal response. Informant incentives and traceability plans were introduced to make concealment costly and prosecution feasible. These measures quickly began to change incentives inside the value chain. The economic effects were immediate and striking. Official data reported that, through the PMMC and GoldBo channels, Ghana's declared gold export earnings reached $2.7 billion between January and April 2025. A surge that reflected both improved declarations and the capture of value that previously vanished. Within weeks, the volume of reported exports climbed, reserves grew, and the central bank's balance sheet strengthened as more revenue stayed inside Ghana's financial system. That sudden inflow was not purely cyclical. It exposed how much value had been leaking out under previous arrangements and how rapid recovery of that value can reshape public finances. Ghana's approach mirrored a broader regional lesson, one that Ibrahim Traore helped crystallize in Burkina Faso. Traore's reforms centered on stopping raw exports, increasing state participation in mining projects, and building domestic refining capacity so that value addition happens locally rather than in far-off processing centers. Burkina Faso's shift toward domestic refining and higher government equity in mining signaled a political willingness to prioritize national gains over the status quo of end extract. The model communicated a simple principle: if the wealth that flows from the ground stays local, the nation gains jobs, tax revenue, and leverage to invest in schools, clinics, and infrastructure. Operationally, Ghana combined legal change with practical enforcement. It negotiated delivery agreements with major producers to bring a share of output into state channels at near-market terms. It licensed buyers under stricter fit and proper criteria. It established assay labs and traceability systems to certify purity. And it used rewards and security deployment to choke common smuggling routes. The policy logic was straightforward: make honest trade easier and safer than theft, and apply penalties that make smuggling unattractive. Within months, small-scale miners, once excluded from formal markets, found routes to sell at fairer prices, receive official receipts, and build reputations that opened up credit and investment opportunities. The political implications were as important as the fiscal ones. Reclaiming value, even temporarily reduced external dependency, gave policymakers room to stabilize the currency, and allowed targeted public spending without resorting immediately to new external borrowing. It also reframed sovereignty. Resource policy was no longer abstract rhetoric but a working lever for social investment. For countries that had resigned themselves to extraction without transformation, Ghana's results were a practical demonstration that governance choices, not scarcity, drove poverty. Predictable pushback followed. Investors and foreign buyers that profited from lax oversight raised alarms about resource nationalism and investor risk. Global trading hubs that had long benefited from opaque flows watched potential market share and informal margins shrink. Yet the counterargument is powerful and obvious. When states sell continuity and predictability, attract responsible investment, and reinvest resource revenue in institutions and infrastructure, they create a healthier, less volatile investment environment than the alternative of chronic leakage and weak public services. The Ghana case suggests that reclaiming value need not mean closing doors to capital. It means changing the terms on which capital operates. There are risks and limits. Institutional capacity must be maintained. Anti-corruption safeguards must be real. Enforcement must respect due process to avoid alienating communities. And value addition requires time, training, and complementary industrial policy. But the rapid spike in declared exports and the broader political momentum it generated underscored a decisive point. Reform can be implemented incrementally and still deliver outsized results if it targets the choke points in the value chain. Ghana's policy package, centralized buying, traceability, legal reform, and targeted enforcement created that leverage for leaders across Africa. The message is tactical and strategic. Tactical: close the leaks, certify purity, and build domestic capacity so more value is captured at home. Strategic: design resource policy as a national development platform, one that creates jobs, builds local firms, and funds public goods. Traore's example showed the political courage needed. Ghana's execution showed it could be adapted in a democratic setting to produce real income quickly. Together, they spotlight a replicable playbook: sovereign management of resources, paired with transparency and incentive structures that reward legal participation if these reforms hold. The long-run payoff is structural, a reversal of decades when Africa exported raw materials and imported finished wealth. Instead, jobs multiply across value chains, technical skills deepen, and national treasuries can fund infrastructure and services that make development durable. That future is not automatic. It depends on sustained governance, partnership with legitimate private actors, and the political will to enforce rules equally. But Ghana's $2.7 billion moment and Burkina Faso's parallel moves provide an immediate laboratory for the claim that sovereignty over resources is not nostalgia. It's practical policymaking that yields measurable results.